Hi, I'm Mike Caldwell. I'm the Director of the Business Innovation Zone. The Business Innovation Zone, or the BIZ, was created to help high-growth potential entrepreneurs and businesses in central Iowa. We provide a variety of services, including mentoring, consulting, counseling, validating business models, and help with access to funding for high-growth companies. We offer also a number of networking opportunities, including luncheons once a month and all-day seminars on subjects such as marketing and finance. You can find out more about the BIZ at www.bizci.org.
Okay, as Mike alluded, not usually the most sexy topic that we do, but very important. And actually, I'm going to try to make it a little different and teach us through some examples today. I think Chris is going to kind of jump in as we go and give some practical examples that give you an idea. But we have to do a little bit of the boring stuff to begin with, kind of give you an idea of what the landscape, what exactly we're talking about. So as I said, we're gonna give you some examples and use that as kind of our basic framework to talk about what the issues are. I think the first thing is obviously what is governance. It's a fancy word for who makes what decisions, applicable obviously to systems of government or management of companies. And the corporate governance rules are more, accurately a specific set of rules about who has responsibility to make what decisions on behalf of the company. So typically, there can be any number of variations on this, but companies are usually set up in this hierarchy. You've got at the top level the equity owners, shareholders of the company. Most of the big companies, they only make big decisions. Whether they're going to sell all the assets of the company, if they're going to go into a different line of business, those types of things. And then you get down to the next level, which is typically directors or managers and LLCs. Typically will meet more frequently than the shareholders, typically once a month or more frequently through committees. They're going to get a little bit more specific into the kind of decisions that they make on behalf of the business. And then the third sort of level of that hierarchy are officers, who are typically charged with going out and actually doing the work that the shareholders and the directors direct them to do. And so basically that's what we're going to kind of focus on through these examples is on behalf of the company, who makes those decisions and what kind of decisions should they make. There's many factors that go into this, and Chris and I could go through examples all day long about the different governance structures that you have. But many of these decisions are going to be based solely on the size of the company. A small company's system of governance is going to be much different than a large public company system of governance. The rules are going to be different. The kinds of decisions that people are making are going to be different. The number of individuals involved is going to have a significant effect. So if you have 3 shareholders of a company, it's going to be treated a lot differently than if you have 100 shareholders. Obviously, listening to 100 people when you make decisions is not nearly as easy as listening to 3 people when you do. If you bring a lot of money to a deal, you're going to want a lot of say. So what contributions the individuals make to the company are going to affect these decisions. From a pragmatic standpoint, the special skills that the people bring to your company. If you have somebody who really knows a part of a business, that's really the capital that they might bring. I have a client that I work with where they have a very specialized employee who makes more than the CEO in the company. He's that important to their organization, and they really rely on him to make a lot of decisions and to really carry that business. He brings a skill set that other people don't have. So if you have individuals like that, that's going to play into how you make decisions as a company. And then also, which is difficult to quantify, but is always important, is the personalities of the people involved. There's always a personal element on how you make these decisions that can't be overlooked. So as I said, we're going to go through some examples that I think are progressively more difficult that address these issues, and then we'll kind of describe the considerations you might have. There's really no right or wrong answer to how you would set these companies up, but these fact patterns will kind of give you a little bit of an idea of what it should be. So probably the simplest example that you can come up with is in this example of company A, three individuals are getting together, they're making a mobile phone application. They're all contributing $50,000 in capital. They're all going to work full-time for the company, and they each have a comparable level of skill from each of the people. So this is kind of a set of questions that Chris and I kind of came up with, issues that you think about in each of those situations. And some will be more important than others, but we'll start right off the bat. We have three people who are contributing the same essential money and skills to the company. More than likely, each of those people are going to want to sit on the board of directors of that company. They're going to want to make essentially all the decisions for the company. And they're going to want them to be equal, more than likely. Obviously, those people, there's nobody who has a special skill that would make it more important for them to be involved in certain decisions. They all basically have the same skin in the game. So, if those three people walked in my office and asked me what I would suggest, I'd say, look, each of you probably should be a board member of that company. And there's some different ways that we can deal with that. The next thing down is officers. As we discussed before, officers are typically the ones who are charged with going out and actually implementing the ideas. This is kind of a difficult question for officers, really, because you don't have anybody with really different skill sets. You don't have somebody who has a finance background, one who's maybe a natural leader that might be a CEO, a finance person might be your CFO. But so typically, when people ask for suggestions on those types of things, there's really nothing other than preference. If somebody is, typically people come in and they say, all right, well, I'll be the CEO, I want to be the CFO, and you be a vice president of something or a secretary, and we kind of go on our way. The next thing that I think we always, this special decisions I don't think is important here because they're kind of all sort of equal in their levels. The next thing that I always think that people need to consider with your companies that'll be brought out in another example is deadlock provisions. Deadlock provisions are essentially, if the company can't make a decision on an issue, how do you overcome that? Naturally, for this company, you have three people who have the same interest in the company. A majority vote would mean that 2 out of 3 would have to go for it. Obviously, if you had only 2 people who were involved in the company, that's always a difficult decision that we'll kind of get to. Rush kind of talked about that before. We talked about that everyone comes in when they're in the honeymoon phase, and yeah, we're going to make all of our decisions unanimously. Nothing's ever going to come up. That's just the way we like to do it. We want everyone's input. That's bad planning at the beginning, because there's always going to be something that comes up that's significant that the people can't make a decision that not everyone's on board for. And it's going to cost you more money in the long run to have no action as opposed to an action that not everyone agrees to. And I've done a series of business divorces that ended up in that situation, 50-50, nobody can make a decision, and everyone spends a lot of money trying to figure that out. And at the end of the day, nobody's happy. This is kind of the next one is always kind of a sticky question, is compensation for duties. People always ask, well, okay, we're all doing the same thing for the company. Should we take salaries for our work? Or do we just want to split the profits? A lot of that depends on on the financial position of those people. Some people need a salary, and we'll suggest it if there's a cash flow for that. But that gets more complicated when people are bringing different things to the table, different people are working. In this example, everyone's pretty much doing the same thing, so salary or splitting profits are probably going to be about equal, unless somebody spends more time for the company, that kind of thing. The biggest one I think that has come up today that we haven't that's been discussed is, and I think we talked about it before, is who owns intellectual property in this example. If you're all three working together, you need to be real clear when you're making decisions at the beginning, who's going to own what at the end of the day. Is the company own whatever the product is, in this case a phone application? Is the company going to own that? Or is somebody individually going to own that? Those are the kind of decisions that you make at the beginning. And then sort of the last thing that a lot of people don't take into consideration when you're getting into companies and you're making decisions about how it's run is, are there going to be any restrictions on on your outside activities outside of that company. So one thing that isn't typically brought up is, say those 3 people who are involved in this company, if one of them goes out and develops another application outside of their time in the company, are they allowed to do that? Is that going to be property of this company or not? That's really a decision that needs to be made ahead of time. So those are sort of the. This example is kind of easy, and that's kind of these are the situation that we're really going to have to think about. I'm going to jump ahead to I'll show you as we go. Sort of the next level of complexity is the same company, 3 individuals, and in this instance, one person is contributing all of the capital basically, and the others aren't contributing any. They're all going to work for the company, and they have a comparable level of skill. This presents a few different issues that come up all the time, and I would say that this is more typical of a lot of the companies that I've worked with than others, is that you have somebody who is really the money guy. And a hard discussion that you need to have at the beginning is how is that compensated? I could make the argument, and I think that the money guys always do, that money is worth a lot. Obviously, all 3 people in this are bringing something to the company, but without that startup capital, you've got nothing. So the real hard decision here is, outside of the fact that they're going to own a bigger piece of the company, does this grant this person any additional decision-making rights? Their money is really what's on the line. The other people have some time involved, but from a governance standpoint, in your operating agreement or your bylaws, are you going to give them any special veto power because of the fact that you're essentially playing with their money? So, some of the examples that you might think of is, they might get more positions on the board of directors to make decisions. That might be one of the rights that you give them. They might have special officer rights or veto rights about who they get to appoint to be an officer. There might be special decisions that they need to make. For instance, if it's if they're going to buy a piece of equipment, for example, maybe they have a special veto right if it's their money. So those are the kind of decisions that you're going to have to talk about ahead of time, but really comes down to the fact that the person who's contributing the capital, they might want to have a special say on what you do. The deadlock isn't really that much different here, except for the fact that the power between the different partners being involved are probably different if one person contributes the cash. Compensation for duties is a little stickier here as well. We still have 3 people who are essentially doing the same amount of work for the company, but one's got more money, and so obviously their equity interest is probably going to be higher in that company. Maybe in this instance you compensate the other individuals involved with a salary to keep it separate between the work part and the actual money. So that's obviously a conversation that you need to have. And like I said, these things are probably, the intellectual property and the corporate opportunities aren't much different than what we talked about. If you decide to go the route of giving employment, to make everyone an employee of the company, obviously you'd have employment agreements that set out what that compensation is. As you grow as an entity and as you diversify, you obviously have perhaps that. If you have a really large company, you might have board of directors who aren't employees that get board fees and those types of things. But for this kind of company, we're talking essentially everyone will be an employee of the company and would have an employment agreement. So, and that's really a negotiation unto itself as well as what level of compensation you'd pay. The next example that I came up with, I'll kind of jump around because I know we're running a little bit behind, but really the main difference that we have here is that only 2 of the 2 non-capital people, the people who aren't putting any money in, are going to be working full-time for the company, and they both have sort of important skill set. And the money guy here isn't interested in operating the company. We kind of talked about this a little bit, but that's, if you came into my office and asked for advice on that, this is a perfect example when you're going to want to compensate those the 2 non-capital people with salaries that's separate from their distribution of profits. And obviously the third party in this case, the capital guy, he's going to want to have a lot of veto power based on the fact that person's not going to be running the company day to day. So more than likely, in this scenario, the guy who was a CPA and got tired of it is probably going to be your CFO of the company. They have the skill set to do that. The other person, natural leader, obviously you'd want to have them running the company. So those are your officers, and the same issues that we run into again with the person who puts the capital up is going to be important there. Okay, so in this example, now we've gone from a company where you have 3 people to a company where you have 30 people that we're raising money from, and we're raising $2 million. 25 people are essentially roughly equal investors in this company. You got 5 people who are developers or idea guys, and then only a few of the investors that you have are really interested in running the money. The rest in running the company. The rest are kind of passive investors. And several of these capital investors have connections and skills that you think will be important in running your business. Okay, so this is where you really where you went from the fact where all 3 investors in the company or all 3 equity owners in the company are board members. It's impractical to have 35 people on your board. So really, this is the kind of company where you're going to want to sit down before you start raising that money and saying, what's a reasonable size board for us to have, where we have input from shareholders who are not actively involved. We have input from the people who have some technical skill in running the company. So all those interests are aligned and are represented. So there's no magic number here, but say you had in this example, you had a board of directors of 5 people. The idea is that you got to sit down and think, what's everyone's representation? Obviously, the capital investors are going to want to have a significant number of those board seats, either allocated to them full time or at least have the right to elect them. You're probably going to want a couple of the technical people that are running your company. They're probably going to want to have some seats on the board. In this example, how do you make that decision? How do you set that up? That's really deal by deal, and it's the kind of thing that you have to sit down and think. If you have real forceful equity investors, they might want to have a larger board and they want to have some seats on the board. The takeaway I think that I'm trying to impart on you here is you don't want to wander into this situation where you have all these people who have say. You really need to do some planning before you start taking on those kind of investors, so that you don't end up in a situation where you have unwieldy approval requirements and those kinds of things. This one I think, further discusses something that we've talked about before, but in this example, you have one significant investor, maybe a DeWay, as we've talked about before, who has a lot more money in the deal than other people. This is going to change the whole way that you set up your board structure. They're going to want to have more say-so in the way that the company is operated. The same issues that we talked about before, as far as having a lower approval requirement from the shareholders, might not be applicable in this situation, at least to that one larger investor, because they're going to want to have more say, they're going to want to have more protection than the other owners. Our same level of decision making is probably going to fall. You're going to have a lot more involvement from your board and a lot more involvement from officers with more delegation of duties.